Okay, good afternoon to everyone attending today. Pleased to welcome you to the next episode in our series, which is taking place over the whole of March, themed for your ISA in 2024. This week we'll welcome three trusts which may allow investors, provide investors with a suitable option for gaining an exposure to themes in the rapidly changing investment landscape. Today we welcome Stefan Gries from BlackRock Greater Europe Trust. And he will be providing a recap of the trust strategy and touching on some of the key exposures and how the portfolio is positioned for the ever-evolving investment landscape. We'll expect the presentation to take anywhere from between 30 and 40 minutes, but that will leave us for plenty of time for some Q&A for the remainder of the session. It'd be great if you can post any questions that you may have using the Q&A function in the bottom of your screens there, and we'll get through as many as we can at the end. So without further ado, I'll hand you over to Stefan.
Thank you, Nick, and good afternoon, everyone. It's a pleasure to be with you today, and thank you most of all for giving up your lunch hour to listen to this update. So I'm the co-head of the European equities team at BlackRock. I'm also the lead portfolio manager of the BlackRock Greater European Investment Trust, and we're going to use our time with you today to provide an update on our current thinking on markets, talk a bit about some of the most compelling investment opportunities that we can find in the European market right now, but we'll also explain how we invest this portfolio, remind you of our investment philosophy, the team, and a brief overview of performance as well. And as Nick said, there'll be plenty of time for questions at the end, so please do ask questions. We like a good debate, but let's see how we go. So to start with, actually, I thought it'd be helpful to remind people what we said when we last did one of these Kepler webinars at the beginning of November. We made the point back then that investors continued to worry about recession. Many macro indicators were weak, and positioning was defensive, with most asset allocators underweight European equities. At the time, we referred to it as the longest talked about downturns in the history of slowdowns, and that phrase we can confidently replace today with the one you see at the top of this slide here, which is the no landing, which followed the recession that never happened, which for us really nicely sums up the sentiment we have seen in our markets over the last 12 to 18 months. Everyone worried about recession coming, partially due to fears around the impact of high interest rates on the economy, China macro data continuing to disappoint, and with some geopolitical concerns thrown into the mix, all of that led to large outflows out of our asset class. Now, one of the key points we tried to get across in November, which is just as valid today, is that we need to remember to be forward-looking. Markets are discounting mechanisms, and the question is not what the world looks like today. The question is where economic activity is heading towards in the second half of this year, going into 2025. And we believed back then that by then we would have inflation levels closer to target, wages growing in real terms, and central banks are likely to start cutting rates. And importantly, the market was going to start anticipating all of this. It doesn't wait until it happens. And we were very much of the view we'd first see economic momentum stabilize and then picking up. And we have more conviction in this view today than we did back then. And yes, markets have moved to some extent, but it's by no means too late to get involved, as valuations in Europe remain highly attractive. In fact, when we look at that valuation chart on the right-hand side there, you can see Europe continues to trade at a significant discount to the US. And that's at a time when US equity markets are becoming increasingly narrow in terms of market leadership. Now, we also want to be absolutely transparent and open, because Europe always trades at a discount to the US, or at least has done for a very long time. But I guess what is quite interesting here is that that discount is as wide as it has ever been. So this is what we've seen, European markets hitting all-time highs, while most investors really were watching this from the sidelines. On positioning, we had lots of evidence of investors scrambling for covering their underweights during the recent full-year results reporting season, where we had some very large European bellwether stocks at times trading up between 12 to 14% in a single day on what were often largely in line to slightly better results. And what this is telling us is that people were expecting much worse. They were running short positions in many cases, and then had to cover those positions relatively quickly. Importantly, again, we don't think it is too late to get involved. There's more evidence of economic activity slowly starting to pick up. And with that, we would expect market participation to broaden out. For Europe, there's always a view that the economy is heavily geared into global growth. Close to 60% of revenues of European companies is sourced from outside the region. That is just a fact. And it is true that therefore European companies will benefit as global growth starts to move higher again. So understandably, investors want to see more evidence of that macro thesis coming through. And I guess our point back in November as well as today is that if you wait for conclusive evidence of this coming through, you will miss quite a decent part of the move. Now, one other way of looking at this is that historically, when we were in environments when rates were cut and those cuts were not followed by a recession, the market was up 100% of the time, 12 months after the first cut. And on average, the move higher was around 15%. So overall, what we can say here is that we can keep it very simple, but Europe is cheap, it is hated, and it's breaking out. And I'll now explain why we see economic recovery coming through over the next 12 to 18 months. So why are we constructive on the economic momentum from here? The first point to make is that manufacturing PMIs have only once in history been below 50, which, as you probably know, is the level that is indicating decline in economic activity. Only once have they been below 50 for longer than the current cycle, and that was following the great financial crisis in 08-09. When we look across our investable universe, we can see that many industries have already been in a downturn for up to 2 years in areas like construction, life sciences, chemicals, and the semiconductor industry. All of those had to deal with very significant downturns that are in many cases now coming to an end and inflecting positively. Manufacturing goods, you probably all remember the COVID period when manufacturers couldn't produce enough household goods. Well, that has all unwound. And again, the goods industry has broadly had its recession already. Supply chains that were heavily disrupted have gone through a long period of destocking now. And the message from many companies that we speak to is that this has now come to an end and inventory levels are broadly in the right place. And when we combine all of this with wages growing in real terms, energy prices falling significantly in Europe, debt costs coming down later in the year, we can easily see a scenario where confidence among consumers and corporates comes back to spend money again and to invest in new projects. Now, the biggest risk to this constructive outlook is for inflation to reaccelerate as and when the economy picks up. That is really the key question. Can we have economic recovery without inflation reaccelerating? We believe that we can, as many of the distortions seen during COVID were driven by lack of supply and supply chains being disrupted. There is no shortage of labor in Europe. Wages are well contained, and supply chains are fully functioning again. And all of this should mean central banks are in a position to ease financial conditions as we go through the year. And with that, they should be elongating the economic cycle we've been in for the last 2 years or so. Now, one of the reasons why some of the pain that was felt in certain industries wasn't seen more broadly across the entire economy is due to some of the significant amount of investment spend going on around us. We all know the world we live in is changing at a rapid pace. We've often thought of those changes as large transformational changes of industries we absolutely need and want to align portfolio holdings to. And what is great about Europe is right here in our market, we can find many companies that we would think of as enabling some of those transformational changes. Companies exposed to the energy transition, electrification of our economies, or companies that are seeing huge investment spent on the back of the trend to reshoring supply chains. In many instances, those trends are only just beginning and come after a long period of underinvestment from many corporates post the global financial crisis. Corporates spent 10 years deleveraging, and while they were doing that, investment spend was rather muted. In fact, one of the CEOs of a UK-listed construction rental equipment business recently referred to this as a modern era industrial revolution with an unprecedented number of mega projects being signed off in both the US and Europe. And in many cases, those projects are being backed by government programs like the Inflation Reduction Act in the US and the European Chips Act. We've put in a chart here on the right that shows one example as it highlights the significant uptick in intentions to bring supply chains closer to home to ensure security of supply. And again, that all should translate into a large amount of spend many of our businesses should be able to tap into. Now, we put this slide in as a reminder to those investors who think they have missed the move in markets and it is too late to get involved. And the point we want to make here is really very simple. Some of these manufacturing sectors that had their downturn, we can now see clear signs of activity levels picking up. But what we shouldn't forget is that those up cycles, they tend to have duration. They last for some time and can produce significant amounts of opportunities for growth in earnings and cash flows in the process. And this chart here refers to the semiconductor industry, which as a subgroup is geared into many different end markets in the economy. It delivers into autos, a big part of the shift to electric vehicles. It delivers into gaming, smartphones, and PCs. And that sub-segment, smartphone and PCs, again, was in a decline and a downturn for over 2 years, and it's now coming back, as well as other industrial applications like 5G, the Internet of Things, upgrading of data centers, and cloud infrastructure, which makes the semiconductor industry very nicely geared into that accelerated adoption of AI applications. Now, for this industry, it is really 2025 when we expect to see the big uplift in sales growth and earnings. But importantly, we should see the order books of some of the key wafer equipment manufacturers that are listed in Europe and that we hold in the portfolio. They should really move materially higher this year. This is also what we're learning from the interactions with management teams, the expectations that the orders will be coming this year, because otherwise it'll be too late for the key clients to deliver in 2025 and 2026. This is why we continue to run significant exposure to this part of the market. Now, another reason why we have confidence in those orders coming through is the outlook statements from some of the largest technology players we put on this slide here. And you can see there on the left a couple of statements. And what immediately stands out is the sheer scale of those CapEx numbers. Alphabet looking to spend 42 billion, which was a significant step up from the prior year. Microsoft CapEx up 50 to 55% year over year. Meta up 25. Amazon equally going to 57 to 58 billion US dollars in CapEx. Now, those numbers aren't just very large, but all of these players also flagged that a significant proportion of that spend is going to go on building out their AI capabilities and infrastructure. Now, the market often thinks of this as just a US phenomenon, but we can actually own European companies that will see a significant benefit from this spend coming through. Now, one of those companies is a business called BE Semiconductor, which was actually the top performing stock in this trust over the last year. They design and produce mission critical semiconductor assembly equipment, which is used by chip manufacturers, assembly subcontractors, and other industrial companies. And they are one of the leading providers of what is called packaging solutions, such as hybrid bonding, which is set to become a very important technology in enabling semiconductor chips to continue to get smaller, less energy intensive, and yet more powerful. And that's really because what we're seeing is that shrink in those chips is reaching its limitations. And with that, the focus is turning to what we call advanced packaging, where basically hybrid bonding solution comes in, which enables new 3D chip structures and architecture, which are required for those AI applications. Basically are the only player in the market with an operational tool, and they've got a very strong partnership with a key US player. And as those machines are becoming more complex, productivity for clients goes up, and it gives them a lot of pricing power, and we see ASPs going up really meaningfully from the existing tool portfolio that they've got. By 2030, we think that basically hybrid bonding revenues should be in the region of 1.5 billion euros. And just for comparison, in 2023, they did about 100 million. So there's a lot of growth coming, and the growth is coming at really high gross margins. And this company already enjoys among the highest margin structures in the industries, and we expect those to continue to improve going forward. So we can think of this as one of the AI enablers, which is listed in Europe. There's a real scarcity value attached to these shares, in combination with the earnings upgrades we're expecting to see in future years should lead to continued nice share price performance going forward. So we talked a little bit earlier about how we like to align portfolio holdings to sizable investment spend that is still in its infancy and therefore has a very long way to run. We basically want to make sure that we own these enablers in the portfolio. And in the industrial sector, it's Schneider Electric, which is a really good example of such an opportunity. On the slide here, which we've taken from a capital markets day that did in November, you can easily detect some of the key end markets and end market drivers the company is exposed to. Again, electrification, decarbonization, artificial intelligence, as well as reshoring of supply chains. And with that, a lot of the mega projects. But it was also at that capital markets day back in November where Schneider laid out a new growth plan and growth algorithm. They're targeting 4-year sales CAGR of 7 to 10%, which is really not a mean feat if you're already generating around 38-40 billion in revenues. And when we look at this business, it can be sliced and diced in lots of different ways, but around 75% of the group is in energy management, with the rest coming from industrial automation. And on the energy management side, we need to understand that up to 40% of all greenhouse gas emissions are coming from buildings. And Schneider offers solutions to help buildings, offices, hospitals, more energy efficient. On the infrastructure side, it holds leading positions in medium voltage that allows for making our power grid smarter, more energy efficient, and capable of dealing with feeding in renewable energy. And that infrastructure segment, again, is set for a really nice double-digit growth in future years. And then it has a segment called data centers and networks, which accounts for around 20% of orders at the moment. And that, again, equally enjoys a very strong growth outlook for the years to come. And one way of thinking about this piece is that demand for data centers is accelerating after we have seen some very data-hungry technology breakthroughs. Again, in areas like the Internet of Things, 5G, generative AI, Industry 4.0, and other advancements. And those increasing data requirements are driving investment into physical infrastructure, which is required to store and process that data. And as you've seen on the previous slide, adoption of applications arising from those breakthroughs will drive power consumption at data centers to rise materially, and with that is driving up capex intentions for some of the key technology names in the US, but elsewhere in the world as well. And again, we find that Schneider's data center backlog and the other structural drivers should very well support those growth ambitions laid out last year, with the third alone coming from the data center part alone. So the good news here, when we look at all of these topics taken together, electrification, infrastructure, renovation, all of that spend is linked to the energy transition. It's going to be very long duration in nature. And I actually think it'll be part of the investment narrative for the rest of our investment careers, which hopefully will be very long. So the ultimate goal for Schneider is to produce 50 billion of revenues at 20% EBITDA margins by 2025. That's nearer term. It's absolutely achievable, and again, should lead to continued nice performance in the shares. And then just to finish off, in terms of other ideas and exposures in the fund, one of the most exciting investment cases that you can find in Europe at the moment is Novo Nordisk. They are a global leader in diabetes care and operate in a segment called GLP-1, where they are effectively in a duopoly with Eli Lilly. Now they produce a molecule called semaglutide, which has already experienced quite significant commercial success in diabetes under the Ozempic brand. That franchise accounted for 50% of sales last year. It also grew by 50% last year, generating gross margins of 90%, which clearly shows you those were huge levers for a value creation, very profitable segment. Now, to make things better, it's really the prospects for the company's new obesity drug, Wegovy, that has moved the shares up by over 80% over the last year. We believe the obesity market opportunity is really very significant. They're estimated to be 764 million people living with obesity globally, and only very, very small percentage of those people are being treated with medication and seen by healthcare professionals. For Novo's drugs, we can see the side effect profiles are very, very mild. And again, particularly compared to older therapies, we can see that patients should stay on treatment for a very long time. Wegovy itself showed very strong efficacy when it came to weight loss. And again, so the side effect profile, very, very amenable. Now, when we look at the US, which is the key market for Novo at the moment, they've got around 600,000 patients that are benefiting from the drug today. But when we look at the market overall, again, the addressable market is much, much bigger. It could be as high as 50 million people, and that's basically people who have insurance or access to insurance in the US today. And one bit that really excites us is that for every 1 million new patients, we get an additional 6.5 billion of additional revenue, which shows the huge potential and runway and growth that lies ahead here. They also had a very successful trial last year that showed that Wegovy reduced major adverse cardiovascular events by up to 20%. And we think that that trial really will help to underpin the validity of this new category of drugs, and again will underwrite the future growth for the business more generally at very attractive and high returns. And what we like here is, as often is the case when you have a successful business growing at high rates, when we look at what the market is expecting and consensus expectations, that consensus tends to fade that growth quite aggressively, particularly in the outer years, which we don't believe is going to happen because there's a lot of new capacity coming on stream at Novo. They're basically sold out for the last 2 years, and it's really only the next 2 or 3 years that they'll be able to start fulfilling some of the very strong demand that is out there. So we remain really excited about this investment case from here too. Let's come on to, I guess, some of the portfolio characteristics. I wanted to start off with by reminding you of our investment objective for this trust, which is to deliver long-term growth in capital for shareholders. Now, to achieve this, we look at our addressable universe of over 2,000 listed companies, and we bring this down to anywhere between 30 and 40 of the most compelling investment cases that Europe has to offer. That means we build a relatively concentrated, high conviction portfolio that invests in some of the best businesses listed in our region. And currently, actually, we're towards the lower end. We're at 32 holdings in the portfolio. It also means that our top 10 holdings typically account for up to 45 to 50%, 55% of the fund. That's really because we want to make our strongest conviction ideas work hard for the portfolio and for our shareholders. But we also absolutely want to make sure that when we look at the portfolio overall, that we source earnings and cash flows at the portfolio level in lots of different ways. And that those top 10 holdings consist of different companies in different industries. And with that, we aim to source returns for our shareholders from across the entire market cap spectrum. Now, ultimately, we see as our job is to carefully construct this portfolio of what we deem to be wealth creators, companies that often dominate their respective markets, where we see that persisting for a long time to come. And our approach really is that once we have identified what we think of as a winning franchise in Europe, we size those positions large and we run them and let the value creation come through over time. In fact, when we sometimes think about what the recipe for wealth creation could look like, we think of 3 key ingredients, and for us those are high returns, growth, and time. And we're often surprised by how little time investors allow management teams to execute on the strategies they have put in front of them. And for this trust, we target holding periods of 3 to 5 years. So it's a low turnover strategy. We don't tend to change the portfolio very much. Now, I also wanted to give a few words on the team. So the team at the moment runs around $30 billion in assets across 12 different strategies. This makes us one of the best resourced European teams in the market. There's 22 investment professionals, and we cover the market by sectors. And the team does over 1,500 company meetings per year. And it's really those interactions with management teams across the market that really helps us to understand what's going on in the world. And the first thing to say here really is we're bottom-up stock pickers, which means we absolutely take the general macro environment into consideration, but all of our views are really coming from the bottom-up work, engaging with companies, researching industries. This is also a hugely experienced team. Many of our analysts have covered their respective sectors for a very long time. We've built a lot of knowledge in important segments of the market. And what makes the team a little bit different and a bit unique is that we lead in a number of different categories. So we have the largest ex-UK franchise in the market. We've got one of the largest income and value strategies in the market, and we also do a long short. And that means that when we come together as a group, we can challenge each other in a very constructive way as different investors are coming to the table, from different perspective. And that's really important for me. I think good decision making is all about gathering as many different insights and perspectives as possible, and to really try and build a complete picture as possible. And this is also why over the years in the team we've been adding to new capabilities like a dedicated data scientist as well as a forensic accountant, all with the aim of leaving no stones untouched and building more and more knowledge and more knowledge than anyone else in the market, really. So over time we believe that should really allow us to identify businesses for which the earnings power isn't fully reflected in forecasts and expectations, and companies that have the potential to therefore significantly outperform the market on a sustainable basis. And that's really what we set up to do as a team, and that's how people are incentivized. And then maybe just very briefly on our investment criteria. So what is it we're looking for when we pick those companies? Already said, we have a universe of over 2,000 companies to choose from, and quite a few of those businesses are global leaders in the industries they operate in. This is also why we've often made the point that you don't necessarily have to have a positive view on the European economy to be invested in this trust. Many of the businesses that we own should do well pretty much regardless of what's happened or what happens to the European economy. And that's because when we pick those stocks, we apply some very carefully defined and strict investment criteria, as our companies are typically run by exceptional management teams with a clearly defined strategy for value creation. It's companies that earn a high return on the capital they invest, and they generate significant amounts of cash, which provides them with the optionality to invest in growth projects at high returns, which ultimately is what you need to see for value for shareholders being generated. When we think about wealth creation more generally, we basically aim to carefully select businesses that align this trust with some of those income streams and capex streams we've already talked about, that have the potential to create value for a long time to come. And it leads us to owning these businesses, the enablers of some of those large transformational changes that I mentioned earlier. It's in areas like reshoring, energy transition, decarbonization of transport, digitalization, and so on. And really the good news is Europe has a lot to offer here when it comes to these enablers, and is leading the world in many of those different segments. So we have a rich opportunity set to pick from, and that's really what this trust is all about. Now, finishing off, let's have a brief overview on performance. Now, first thing to say, when it comes to performance is we believe we can deliver the best outcomes for investors in our trust over the medium to longer term. You can see here that over 1 year to the end of January, the trust outperformed its benchmark by around 5%. And if you cast your eyes over those 5-year numbers, which is where we spend most of our time thinking, you can see our NAV has outperformed its benchmark by just under 34% over those 5 years. And because Europe often gets a bad press when compared to the US stock market, I thought we look at that 5-year return in a bit more detail and compare it to the return of the S&P 500 over the same period. And when we do that, we find that this absolute share price move of 92% in our trust compares to the S&P 500 being up 82% over the same period. And this really shows that Europe has a lot of fantastic businesses and investment opportunities to offer. It also highlights how important it is to take an active approach to investing in European equities, and how important it is to have a well-resourced team that firmly focuses on producing that growth in capital over the medium to longer term. And for us, it's really a reflection of taking and adopting that long-term approach where we own businesses rather than trade around in shares on a daily basis. And with that, we've actually come to the end of the presentation, and I hand it back to Nick to see whether there are any questions.
Thanks, Stefan. That was a really informative presentation. It's nice you honed in there on a couple of good stock examples as well that have driven some of the performance. I suppose because you finished off on performance there, it's probably a good point to start. We highlighted it a few weeks ago in one of our sales emails. What do you think has driven that more short-term performance, I suppose, even over the last sort of 6 months or 3 months, even since the start of the year? I think we highlighted some of the luxury goods within the portfolio there that were potentially driving that. And what are your views on that kind of sector moving forwards as well?
Yeah, I mean, there have been a whole host of companies that have been performing quite strongly for us over the last 6 months or so. But, definitely luxury goods was one sector where, when I was talking about earlier, positive surprise around full year results, big share price moves, it was just a classic example of a sector people want to own for the medium to longer term. But everyone understood that near term, you go through a normalization of growth, post very strong growth in the COVID years. And, people were underweight, a few people were short. And actually, when LVMH reported, what we could see was that there was fantastic cost control, margins coming through stronger. And yes, we all know that the first quarter is still suffering from tough comparatives, and the growth would be slightly slower. But we also think that as we move through the year, you'll see re-acceleration of that growth, because the medium to longer term thesis on all of these names hasn't really changed, and there's still a lot of pent-up demand for particularly from high net worth individuals for a lot of their products. And I guess the other bit that came with this was like a lot of the valuations had come down a lot, and so I think people were afraid of missing out, which is one of the other reasons why we saw the strength in the shares post full year results. So ultimately, a sector we want to have exposure to. We think it'll prove more resilient over the cycle. We had to go through painful readjustment. You can't keep growing at 20% forever, and so we're now moving back to a paradigm where you're growing top line 8 to 10%, but that's fine at high returns with a balance sheet that's net cash and valuation that has come down a lot. So that would be the way we view that part.
How much, I suppose, as a bit of a follow-on from that, how much do you think the Chinese consumer is going to begin to impact that kind of exposure as well?
Yeah, I mean, the Chinese consumer has always been important, and we monitor this very, very carefully. So one of the benefits of having a dedicated data scientist is that we basically track spending by Chinese consumers very, very closely through the credit card data, and we can see kind of how it's developing and evolving. And what we find is that at the higher end, again, actually that spend has held up quite well. It wasn't quite as strong as people were hoping last year when we had the reopenings, but it's still growing at very attractive rates. And the Chinese consumer is also still has to come back in a bigger way in terms of global travel, which is a very profitable channel for luxury goods. But I guess the other bit to remember is that there's many other markets that they have opened up over the last 5 to 10 years. They for a long time, for instance, in the US, they were only represented in some of the key and large cities, and they've gone into some of the oil states in a bigger way. So Texas is a good example there. So opening up new markets in countries like the US, Middle East, and other emerging markets. So and one of the benefits that you've got, if you're very high end, you've basically been short of supply, and so if you have weakness in some markets, you can just redeploy that product and capacity to the markets where demand remains very, very strong. And so that's what we've also seen with some of the players that, because of shortage of product, they've been very clever at, shifting product to the most profitable markets if there was, weakness in one of the other markets. So, but China is something we monitor very, very closely. For the time being, there are no red flags when it comes to luxury goods consumption. They are at the lower end of the consumption spectrum, so it's definitely something we will keep monitoring closely. But it's also something companies are not too worried about at this stage.
I suppose, breaking down the portfolio a little bit more, you hold some banks in the portfolio. So do you think there's still an opportunity with that trade there, given the rates environment?
Yeah, Nick, I heard you use the word trade. So we try not to have a trade like that, but basically, so which is actually a nice way to just remind you. So when we put a new holding in the trust, it's basically one of the first questions I ask myself, and Alex and I, the co-PM, ask ourselves, so can we own this asset for the next 3 to 5 years, and why? Can we sit in front of the board? Because we have to sit in front of the board 5 times a year, and everything gets questioned and scrutinized in a very constructive and positive way, and say, well, we just bought bank X, Y, and Z, and we're going to own it for the next 3 to 5 years. That's quite a high hurdle. And actually, so we do own some banks, and we own the banks that operate in consolidated banking markets where they have very high market shares, where they have pricing power. And importantly, what we find is that the bank sector right now garners a lot of debate because it was seen by many as a key beneficiary of rising interest rates. And clearly, it's been a massive benefit to bank earnings. I think at the sector level, we've added something like 100 billion euros in net interest income in this rate cycle. And then right now, the worry is what happens when rates are going to be cut. Does that mean banks can no longer perform? And I guess our perspective for the banks that we own is slightly different. We actually think that the earnings will prove to be a lot more resilient. We think that the market never priced in the current levels of interest rates at 4%. The market went to 2.5. And most importantly, also valuations have remained depressed. And one of the reasons why valuations have remained depressed is because people were worried about recession in Europe. And we therefore think that as you have more evidence building of PMIs moving higher in Europe, which they have started to do, we should see a re-rating. And those banks are still throwing off a lot of capital. And they're basically overcapitalized, and we'll see more and more of that capital coming back to us in the form of dividends and share buybacks. And in some of the names we hold, we get something like 16-70% of market cap back per year for the next 3 years in shareholder returns, which we actually think is really quite an attractive proposition. So that's one of the true value opportunities we can find in the market, and we're happy that we have them in the portfolio.
Mm-hmm. A more technical question about trust, referring to the discount. So any discount controls, if any, are they employed by the trust? And what's your sort of outlook for the discount moving forward, I guess?
Yeah, so and we take that very serious. So the board really wants to manage the discount on the trust, and so typically, when we above 4%, we tend to there's a biannual tender mechanism, but we also have the flexibility to go into the market and buy back shares in between to manage that discount. And that's exactly what the board has been doing recently. I believe we have one of the narrowest discounts to NAV in the category. We're not quite there yet where we went 2021. 2021 was the year where we basically issued shares pretty much all year. But again, for me, that's part of the view of investors on our asset class more than anything. And I actually think that the longer European markets keep moving higher, there's more of a need for asset allocators to close those underweight allocations. And with that, we would expect hopefully that discount to continue to narrow and go back into growth mode. But clearly, that piece is at our control. We can focus on performance. We can make sure that people have a positive view on our team. But ultimately, for people to take a more positive view on Europe, slightly out of our control, but this is why it's such a great opportunity to speak to everyone today, just to remind people that there are a lot of good things going on in our market right now.
Mm-hmm. I suppose out of my interest as well, you touched on the narrowness of the US market, and there's been a bit of news about the granolas in the European market, for example. What's your opinion on them stocks? And I suppose what's the portfolio's exposure to them?
Yeah, I mean, to be honest, in the first instance, it's we were actually discussing this in our morning meeting this morning, that investment banks have a habit of coming up with new acronyms because I think there's a money-making opportunity if you create baskets around them, and they seem to be coming along like London buses at the moment with new acronyms coming up all the time. So clearly, we own some of them, but we own them for what we think are very strong underlying fundamental reasons. And actually, we often invite our clients to come and sit down with our sector specialists on some of these stocks that might be part of the granolas. And I'm absolutely convinced that we hold more knowledge on these stocks than most people in the market. Now, what it does, it can create some volatility. I'm sure of that. But again, if you have built that conviction and you've built that knowledge, you can use volatility and profit taking and sell-offs, to your advantage. And we tend to use those moments to, unless the fundamentals have changed, we use those moments to make sure that we're at the right position sizes and happy to take the other side if there's volatility that is not backed by fundamentals and news. But I guess implicitly there's a question on how do you think about owning stocks that might be slightly crowded. And again, we look at that as well. But ultimately, what we are guided at most importantly is what's happening to earnings and cash flows. Is the business we own still in a position to over-deliver on earnings and cash flow expectations? What is the valuation of the business relative to its most relevant peers? And often those peers are actually global in nature. And so those are all the factors that really matter to us. You want to see positive earnings revisions, positive surprises, because that will ultimately drive share prices higher over time.
Okay. I suppose we're going to have to touch on whether you see any kind of risks moving forward over the next kind of year, and I suppose how you're kind of positioned to that. You mentioned about being a bit more defensive last year, a bit earlier on, but also touching on gearing maybe and seeing how the portfolio is doing as well.
Just to be clear, actually, we never really moved the portfolio defensively, and we've been running positive beta, positive gearing on the trust for quite a long time now. So, and that's partially also because of the philosophy of this trust. Because let's say, like if we felt that there was a period of 3 to 6 months where the economy might be weaker, we're not going to change on that kind of nearer term view. We change if there's a major break in an investment thesis. That means the earnings power of the business is impaired for the next 3, 5, 10 years, and sometimes that happens, and we have to make changes. So, the gearing of the trust at the moment is around 8%. So again, positively exposed, constructive view on markets. and where we're taking, let's say, cyclical risk is in areas like semiconductors and areas like consumer discretionary through the luxury goods. It's in areas like construction, where again we actually think that construction end markets to some extent have had their downturn already and will benefit from rates coming down. But equally, we're obviously not all out. We will always have a segment of the portfolio that we think of as our defensive bucket, where we have very dependable earnings and cash flows, and those businesses play a really important role from a portfolio construction point of view as well.
That's great. I'll encourage any more questions to come through if there are any, because we are getting a bit closer to the end of the session. Okay, can you tell us more about the duration of the gearing and its redemptions? A bit more of a technical question on the gearing.
Yeah, so I guess, the way this works is that we have you can think of it as an overdraft facility, where we have a set amount we can draw on, and really we would be the first people to say that we don't try to time the market. We don't think we'd be particularly good at it. So the way we use that gearing and that overdraft facility is to, again, opportunistically, where we have very strong bottom-up views on stocks, to make sure that we really make our highest conviction ideas count. Sometimes we use it to implement new ideas as well. But ultimately, it will move the gearing, that is, with a view on what's happening bottom up to earnings and cash flows, where we see the opportunities. So right now our expectation is absolutely that we kind of stay in a region of kind of where we are, somewhere between 6 to 10%. Right now we're right in the middle. I don't really expect that to change in a bigger way.
Okay. We did have a question here about some of the charges, just quickly, about the management charge and any performance fee. I don't know if you could just cover that off quickly.
Yeah. So the trust doesn't generate a performance fee, and the management charges, they are tiered. They basically are 80 basis points for the first 500 million in assets, and then it comes down thereafter. We think it's quite a competitively priced trust, particularly given the performance we've managed to deliver over the longer term. And I just come back to what I said earlier. So when you think about building a portfolio, you can think about implementing a view on a certain region, and a lot of our clients are doing this by taking a hybrid approach. So you can say, okay, I want some very cheap exposure to Europe, and I can do that via an ETF, and you can choose the index, and then you can combine it with what we think of as a high alpha strategy, which is where the trust comes in. And you could argue that obviously the management charge is slightly higher than what you pay on an ETF, but then I'd invite you to think about kind of what it could potentially generate over the medium to longer term. And again, you can see this on this slide here, in terms of outperformance relative to the FTSE Europe ex-UK over 5 years of over 30%. So it's a question of economics and kind of where you want to, how you want to build your portfolio, and clients are using both to express views on a given region.
Okay. I think, given the time now, Stefan, I think we should probably wrap it up there, unless you have any closing remarks.
No, I guess I always tell myself it pays to be an optimist. If our thesis is wrong, that's another, maybe a final point. Let's say the constructive thesis of growth stabilizing, starting to pick up again. If it is wrong, it won't be wrong for very long, because what we will see that if the economy ends up being much worse what people are currently expecting, you will see those rate cuts coming through much faster. And again, we just have to bear in mind that lots of industries have been in a long decline already, and we actually think that you could see again moving out of a bit of a decline in economic momentum, really quite quickly. And so that's why we're quite constructive. It's not our base case anyway, but it's just something to bear in mind.
Brilliant. Okay, well, I think we'll try and wrap it up there then. So thank you again, Stefan, for the update, and thank you all for tuning in today and your questions as well coming through. They really are appreciated. A recording will be available on the website in due course. And if you do have any follow-up questions, please do get in contact with us and we'll get back to you as soon as we can. So we look forward to welcome you over the course of the month. And so, yeah, thank you very much and have a nice rest of the day. Thank you.